Assalamu alaikum. Good afternoon, audience. This is Mustafa Ahmed Mirchawala from Mirchawala's Hub of Accountancy, and I'm your trainer for F6 Prepare to Pass sessions. Right? Let me give you a little introduction. I've been teaching for last 16 years, and my primary papers are F6 TX, F7 FR Financial Reporting, and SBR Corporate Reporting, Strategic Business Reporting. Right? Okay. I'm also a vlogger. I also make videos and all stuff, and also IFRS trainer as well. Keep in mind one thing, that we have total 15 hours, 5 days, 3 hours per day. So our each and every minute, every second is very, very important, right? Okay, so let me quickly discuss you a paper format, then some exam techniques, and then we'll shift to our first topic, that is income tax computation, right? Hello. Okay. Can you hear me? Kindly reply on the chat. Can you hear me? Can you see me? Is the screen sharing is perfect? Screen sharing, everything is perfect. My video, my voice. Okay, let's move to the paper format. You will have three sections. Section A, 15 MCQs at the rate 2 marks each. Now the question is, sir, from where we'll get 15 MCQs? These from any part of the course. It's mixed, nobody knows. It may be from corporation tax, it may be from NICs, it may be from CGT, IHT. It's a mix. Okay. Then section B. Section B, you will have 3 OT cases. OT cases, you must know the meaning of OT cases. 3 cases with 5 MCQs each, or 5 boxes each, right? Okay. One OT case is equal to 10 marks. So obviously this will be 30 marks. This will be 30 marks. Now the question is, sir, from where section B will come? Normally the past practice of examiner is from section B, he normally tests 3 areas: CGT 10 marks, IHT, that is inheritance tax, 10 marks, and value added tax, 10 marks. This is the past practice, but examiner may change it. Right now, section C. In section C, you have to do presentation. Section A and B, no presentation is required. You just have to tick and you can clear. In section C, the constructed response area, CRA. So you will have 3 questions in section C, 1 question at the rate 10 marks, and 2 questions 15 marks each. Now the question is, sir, from where this 10 marks question will come? This may come from any area, like losses, like tax planning, like NIC, any area. That's the wish of examiner. But the remaining two questions of 15 marks each normally comes from, one comes from individual, that is trading income, employment income, partnership, mixture of such thing, right? And one comes from corporation tax, right? Okay, so that's how your 100 marks will be done. Now the question is, sir, what's the average passing rate of this paper? Luckily, the passing rate of this paper is always good, like around 45 to 50%. And for a professional qualification, this passing rate is excellent, because you all must know this, that there are some papers in ACCA even on which the passing rate is just 35 to 40%. So average passing rate between 45 to 50% is very good, is very, very good, very good. That's why normally students opt this paper on the first instance, so that they can clear it easily, because this paper is majority practical. I would say it's 80 or 85% practical with 15-20% theory. Right now, going forward, I have written some exam tips for you, and listen it very carefully. Okay, we are investing our time for them, as this is a paper of learning. All of you guys are here for revision session. That means you have already studied. This paper. So you must know, in tax paper there are small many things, many rules, regulations. So your learning power must be strong. Now the question is, sir, how to learn? Always maintain exam folder. What is exam folder? Giving you example. Listen, for example, you just studied property income. Now you take a page and write the summary of property income in one page, right? Okay, and put it in a folder. Then you studied the second chapter is income tax computation. You made a summary of income tax computation in your own words and put it in the that folder. That now just think, let us say there are total 20 topics, so you will have 20 pages or 25 pages in the exam folder for each and every topic. Now just you have to see that folder written by you, so you can recall everything, because this paper is about recalling and recapping. So put it in this in your mind that exam folder is very important. And believe me, in past last 15 or 16 years, many of my students maintained this and they got positions, they got nationwide position and even worldwide position. Even recently, the last attempt, September 20 attempt, my student Khadija Anis, she scored 89 marks and nationwide position Pakistan top in F6TX. So I asked that lady that did you maintain exam folder. She said yes, and this is a very big exam tip or study tip, right? The second, read technical articles. Read technical articles. You know, you can visit accaglobal.com. You can visit accaglobal.com and you can read many, there are many articles related to CGT, IHT and all. One more thing, always for all papers, examiner reports are must. Examiner reports are must. Even I also read examiner reports. You get many mistakes done by students in the past, so that you don't repeat it, right? Okay. Now then, solve exam kit and past papers. Obviously past papers and exam kit is must, but one disclaimer, open your eyes guys, open your eyes, listen. For text paper, don't go to internet, don't go to accaglobal.com for past papers, because majority, I must say 90% of the past papers are outdated. They related to past fiscal years, which are no more applicable now. So it's better you do exam kit. In exam kit, all past papers are amended and they are latest. Okay, use latest exam kit. Okay, FA 2019. Then this I told you, recalling and recapping with your friends if you have time. See, if you have time, right now we all are running short of time. So this tip was for those students who are studying full time studies. Those who are studying, hello, तो उसके कैसे सही होगा? तो मैं वेट करूं? ठीक है, आप बताएं. Actually some students having voice issues, so I'm just waiting 2 minutes for them. Okay, don't worry. Please give your voice feedback that can you hear, and also join from the laptop, don't join from your cell phone. Okay, now don't forget in OT cases, especially examiners in OT cases. For example, in OT cases there are 5 MCQs, and the MCQ contains theory requirements, true or false. If you do one mistake, the complete question will be treated as wrong, 0. So be very careful in reading the information of OT cases, the section B, right? Okay. Now I always say to my students, open your eyes. When planning preparation, there are some areas which are totally cash areas, which are a must come in exam. They always test those areas, and those areas are, look at me, CGT, IHT, inheritance tax, value added tax, all separate areas. CGT, IHT, value added tax, corporation tax. Normally, if you do each and everything, because these are small areas, each and everything of these areas, you can easily score around 60 marks, just for your clarification. CGT 10 marks fixed, IHT 10 marks fixed, VAT 10 marks is fixed, and corporation tax 15 marks is fixed, 45. Plus you also get MCQs from section A from these areas. So in short, we can say 60 marks from these areas. So these are very cash areas to clear the paper, right? Okay, then you must be using exam kit, and normally students in F6 use Kaplan exam kit. So if you see the starting pages of Kaplan exam kit, you can see claim state of different losses, different penalties, self assessment. There are 4 pages around for claims date. Must read and must learn it, because they are also very cash marks, just marks, right? Now then, these wordings, the last 3 lines are from your that examiner report. Always read the guidance notes in the requirement. Hold and think over it. You know, in the last 40 marks, sometimes you have to do from accounting net profit, you have to do a journey from accounting net profit to tax adjusted trading profit. In the requirement, examiner sometimes says that start from PBT, or sometimes examiner says that start from profit after tax, or sometimes examiner says that start from profit before interest and tax. So must read the guidance notes so that you do it what examiner is asking, right? In this way your time will be saved. So specifically examiner has written these lines in your examiner report that students do this mistake. So read the requirement carefully with open eyes, right? Now one more thing, you have seen that many students waste times in workings. They do a lot of workings, and this will consume times. So for short working, like for example, car benefit, there is a car benefit, cost of car multiplied by the percentage, so you can do in the main sheet, you can do in the main spreadsheet using brackets. So in this way your time will be saved. This is the instruction of examiner, right? So no need to do each and every working on a separate page or separate lines. Okay, now for theory, write each point in a separate line. If, for example, you have to write three points theory, so it's better use 3 separate lines. In this way the marker can give you marks easily. It's easy for the marker to check the paper, right? Just put your feet in the marker's shoe, so you will understand. Also one more thing which I have not written here, but I must say this, listen. And that thing is that last 40 marks you should practice on software. Sir, where's the software? You can go to accglobal.com, and there is an area, CRA, constructed response area. You can work all questions on CRA, because in the past, this is the feedback of students, that those who don't practice on the software in the examination room, they normally cry. So be careful, you have to work on software. One more thing, few years back when this paper was paper based, students used to give using pen and paper. So at that time, one of the reason of failure was poor handwriting and poor handwritings and poor layouts. But now there is no handwriting, because now you just have to type. So no more failures because of handwriting. But yes, layout is still important. How you can underline, you can separate line, you can make separate lines, you can do neat and clean work. Okay, still layout is very important for examiner, right? So don't forget. Now one more thing, very important. As these sessions are just a revision sessions, we are running short of time. See, 15 minutes gone. It's 4:15, 15 minutes gone in just general discussion. We haven't started any revision right now. So that's why I'm making a WhatsApp group for you guys, so that I can send you more data, I can send you mock exam, I can give you more help. So our team is sending you a WhatsApp group link. All of you must join that WhatsApp group and don't leave that WhatsApp group till examination date, right? Okay, so that's very important for you. Now we are starting. The first thing is, I always say like this: in taxation, come on, be active guys, be very active, look at me very carefully. Just think I'm sitting in front of you in a room. Just think it's like a physical class. Now in taxation there are three things. Whenever somebody asks you to calculate tax, first you will ask, sir, what's your income? So what we have to do, first we have to calculate incomes. Number two, then we have to compute tax on that income, and then we have to pay the tax. These are the three major things of F6 paper. Number one, incomes calculation. If somebody asks you how to calculate tax, first you will say, tell me what's your income. So we have different types of income. Go and see the screen. Property income, employment income. If you are doing job, you will have employment income. Trading income, if you are doing business, you will have trading income. Interest income, if you are putting your money in a bank account or a loan notes, you will be receiving interest. Dividend income, if you are investing in any shares, you will get dividend income. And also capital gains. Now open your eyes. For property income, yes, you have to make a P&L. There is a proper working for property income. Yes, P&L is required. And what's the format of P&L? You must remember: rental income less allowed expenses. Then for employment income, yes, you have to make a P&L. And you guys used to make P&L for employment income as well. If you remember, salary, bonus, car benefit, fuel benefit, accommodation, less allowed expenses, right? For trading income, yes, you also have to make P&L. For capital gains, yes, you have to make a mini P&L. Hope you remember: disposal proceed less allowable cost is equal to chargeable gain. But my dear students, for interest income and dividend income, there is no P&L. No profit and loss. Interest income and dividend income, you have to directly pick from the sheet and just put it in for direct tax computation, right? But don't forget, look, listen my voice. Interest income as and dividend incomes are taxed on receipt basis. Interest income and dividend income are taxed on receipt basis. So for interest income and dividend income, receiving date is very important. If receiving date falls in your fiscal year, then you can take it, otherwise leave it. Now my dear students, this is the fiscal year. In UK, fiscal year starts on 6th April and it ends on 5th April. And what's the relevant fiscal year for your paper? That is December 2020 attempt. This is 1920 fiscal year. We are studying guys 1920 fiscal year and 1920 fiscal year. 1920 fiscal year starts on 6th April 2019 and ends on 5th April 2020. 5th April 2020, 6th April 2019, and ends on 5th of April 2020, right? Okay, so don't forget this fiscal year. This is a relevant fiscal year for you guys. Now. Okay. Come on. Now you can see a sheet in front of you. I always say to my students, whenever you are asked to calculate tax for individual, three columns will automatically come in your mind. The first column is, open your eyes, non-saving, NS. I have written NS. The second column is interest and third column is dividend. Okay, in non-saving, normally trading income, employment income, property income, and sometime pension income as well, but I have not written here right now. Okay, don't worry. Then in the interest column, you will write interest income. In the dividend column, you will write dividend income. Open your eyes, please. Then you will add three of them. Then you will add three of them. You will get total income. You will get total income. Look at here. This is your total income. This is your total income, right? Okay. Then from total income, we sometime deduct qualifying interest. If you have taking loan for qualifying purposes, then qualifying interest will come here in, it will be deducted from total income. Now what's the next number? After deduction of qualifying interest, you get net income. You get net income. Hope you remember. At the net income, you just apply brakes. You just stop your car. And what you do, see, you just add all your net income. You just add all your net income, and you go here. See, there is a side working. From this total net income, you deduct two things. Open your eyes. Number one is cross gifted donations. If it is given. And number two is gross personal pension contribution. In short, we say gross PPC. When you deduct these two, you get ANI, adjusted net income. Now the question is, sir, what is the purpose of this ANI? Hold. This ANI, or adjusted net income, is used to calculate personal allowance. Now hold. See, in my screen I have already written your personal allowance is dependent on ANI. Let me recall you the timeline. Listen, if your ANI is between 0 to 1 lakh, then you have fixed personal allowance of 12,500 pounds. If your ANI is between 1 lakh pound, 100,000 pounds and 125,000 pounds, then you have to do a reduction working. Hope you remember the reduction working. Your personal allowance will start reducing gradually. And if your ANI is greater, than 1,25,000, then you are not eligible for any personal allowance. Your personal allowance will be zero. Okay. So this side working, why did we do this side working? Why did we compute this ANI? Principally because we need to compute personal allowance. Right? So once you get the personal allowance, come to the main sheet. Okay, look at here. Once you get the personal allowance, come to the main sheet and write your personal allowance here. Now from net income, you will deduct personal allowance and you will get taxable income. Now the question is, sir, what is taxable income? Taxable income is the income on which you directly apply the tax rate. Now hold. Hope you remember, because all of you must have studied tax. This, if you add these total taxable income, look at here. If you add these total taxable income, this shows your tax status. That either you are a basic rate taxpayer, or you are a higher rate taxpayer, or you are an additional rate taxpayer. So don't forget, whenever you need to check the status of taxpayer, always use total taxable income and bands. Total taxable income and bands. So you will come to know that this guy is basic rate taxpayer, or higher rate taxpayer, or additional rate taxpayer. One second. Hello. अच्छा, मेरी तरफ से तो कोई इशू नहीं है ना? चलो मैं रुक रहा हूँ. Again, there are some students, they have voice issue because they have joined from cell phone. So I'm just giving 2 minutes break. Again, Okay, now see on your screen, I've already written this. If your ANI is less than 100,000, you will have a fixed personal allowance of 12,500. If ANI is between 100,000 and 12,000, 12,500, 125,000, then reduction working. You will have to reduce your personal allowance gradually. And if your ANI is greater than 1,25,000, then you are not eligible for any personal allowance, that is zero. Now these are the tax rates, and these will be given ready-made in your exams, and I hope you remember. See, I have written in a different style 0 to 5,000 and then 5,000 to 37,500, but in reality this tax rate is like 0 to 37,500. That's your first band, the basic rate band. Then 37,500 to 150,000 is higher rate, and 150,000 and above is additional rate. Okay, now listen. you know you have studied that sometimes we stretch these bands. For individual, these tax bands are stretched because of only two reasons. Number one, gross gifted. See, I've written GAD. Tax bands are extended because of two reasons. Number one, gross gifted donations, and number two, gross PPC. These two are the only reasons for which we extend our bands. Now the question is, sir, which bands we do extend? Only the 37,500 and 150,000. We never strike this small 5,000 band. We can only strike 37,500 band and 1,50,000 band with gross gifted and gross PPC, Now one more thing. For this qualifying interest, look at the screen. For this qualifying interest and personal allowance, what is the priority? Always deducted from non-saving income first, then interest, and then dividend. Always the priority for deducting personal allowance and qualifying interest is always first deducted from non-saving. If something is left, then go to interest. If something is left, then go to dividend. Okay, right? This is the order. And now, sir, what is the tax computation order? What is the tax computation order? Tax computation order is again the same: non-saving first, then interest, and then dividend. Non-saving first, then interest, and then dividend. Now one special question. Check the screen. See, tax computation order I have written. Always first we'll do non-saving income, then we compute interest income tax, and then dividend income tax. Now in normal circumstances, how do we calculate interest income tax? Listen, for interest income, always use first NRB, and interest NRB is given according to the status of the taxpayer. If taxpayer is basic rate taxpayer, then interest NRB is 1,000. I hope you remember. And if taxpayer is higher rate taxpayer, then interest NRB is only 500. And if the taxpayer is additional rate taxpayer, then no interest NRB is available. No NRB on interest is available, right? So whenever you need to, in normal circumstances, whenever you need to calculate tax on interest, always this is the order: first NRB, then normal tax. Now how to calculate tax on dividends? For dividends, always use first NRB, and this NRB is fixed. For dividend, NRB is fixed irrespective of your income. Dividend NRB is fixed. And for dividend, first you do NRB, and then normal tax. First you do NRB and then normal tax, and this NRB 2000 is fixed, right? Okay. Now sometimes students ask this question. Look at here. Can you see the tax bands? Come on, look at here. Can you see the tax bands? There is a 0%. See this. Look at here. There is a 0% band as well for interest. There is a 0% band for interest as well. Sir, when can we use? When can we use this interest 0% band? Look at here. Look at here. When? Listen. Whenever this non-saving income column final answer is less than 5,000. Whenever your non-saving income taxable income is less than 5,000, then in that question, look at me, in that question you will use the 5,000 small 0% band of interest, right? And in that case, what will be the tax order? What will be the tax computation order for interest? First of all you will use 0% band of interest, that 5,000 band, then NRB of interest, and then normal tax, then NRB and then normal tax. Sir, can you tell me, through timeline? Yes. Listen, if if your non-saving income column final answer is less than 5,000, then this timeline will be used. Listen, your bands will be like this: 0 to 5,000, 0 to 5,000 first band, then 5,000 to 37,500 second band, and then 37,500 to 150,000 third band. In this way you will plot your bands, right? Okay. And this case will only be applied when your non-saving income column final answer is less than 5,000, In that case this band computation will be done for interest. Okay, right? Now there is one more topic. I hope you remember the transfer of personal loans between spouses, husband wife and civil partners. Listen, this is normal this is very normal in families. Sometime husband is working day and night and wife is not working. Wife is like housewife, right? Okay, so just think housewife income is very less, like only 3,000 or 4,000. So housewife won't even be able to use her own personal loans. So that means the personal loans of wife will be wasted. So the tax department has allowed us to transfer personal loans between husband and wife, unused personal loans between husband and wife, right? But there are some conditions which must be fulfilled before this transfer. Number one condition: both of them, both husband and wife must be basic rate taxpayer. Both husband and wife must be basic rate taxpayer, right? Number two, fixed, there is a fixed amount. 12,500 is the original allowance, multiply by 10%. Only 1250 fixed personal allowance can be transferred. Only 1250 fixed personal allowance can be transferred, right? The person who is receiving this personal allowance, for example, wife has transferred 1250 personal allowance to husband. Wife has transferred 1250 personal allowance to husband. 1250 personal allowance to husband. Listen, husband the husband is the guy who is receiving the personal allowance. He cannot increase his or her personal allowance. He can only reduce his or her final tax liability by 1250 times 20%, that is 250, right? Okay, so never do this, that if you are receiving a personal allowance, if husband is receiving personal allowance from wife, husband cannot increase his or her personal allowance. He just have to reduce his final tax liability by 250. This is the amount. Okay, now now let's move on to the primary topic of today's, and that is CGT, capital gain tax. Students, remember this, that we are running short of time. We have to do question. This is a question based revision session, but still I am giving you some points so that you can recall the concept. Listen, CGT, you first of all you must remember, CGT can can only be applied on chargeable asset. CGT is only due when you sell, when you gift, or when the chargeable asset is damaged or destroyed. So the asset must be chargeable asset. So that means on exempt asset there is no CGT. On exempt asset there is no CGT. Open your eyes and see, there is a list. Certain vesting chattels, inventory, government securities, guilds, ISA, individual savings account, investments in individual saving account, qualifying corporate bonds, and there is one more thing, principal private residence. Private residence, if it is completely owned and used for residential purpose, then it's also exempt, and we'll be doing this soon, right? So these are some of the exempt assets. And there is no CGT on exempt asset. Now check with the red pen. When CGT is due, which transaction contains CGT? When we have to calculate and compute and pay CGT? When a chargeable asset is sold. Number two, gifted. Yes, on gifts it's also. And number three, damage and destroyed. Hope you remember, with sometime damage and destruction, there are insurance proceeds are also involved, and for that you have to compute capital gain. Now look at the screen. Now basic working. What's the basic format of capital gain calculation? Disposal proceed means you sold the asset, the proceed is disposal proceed, less allowable cost. Open your eyes, please. Allowable cost. See, I have made an arrow on allowable cost. See, these all costs are allowed. Look at here, these costs are allowed. These costs are allowed. Listen, number one, original cost of purchase. The cost you paid, to buy that asset. Then legal cost to buy or sell that fixed asset, including commissions as well, and improvement or enhancement in so these three costs are normally allowed in capital gain tax calculation. Okay, so what's the format? Disposal proceed, less allowable cost, you get the chargeable gain, and from that chargeable gain, you can less annual exemption. Sir, what is the amount of annual exemption for your fiscal year? The annual exemption amount is 12,000 fixed. Now the question is, sir, then what was personal allowance? Listen. Personal allowance, what was for revenue receipts, non-saving interest dividend, that was the revenue receipts world. Now we are coming to capital receipt world. In capital receipt world, we have annual exemption. In the revenue receipts world, we have personal allowance. Now don't forget, personal allowance, look at here, personal allowance can be reduced to zero, but annual exemption is fixed. Annual exemption 12,000 is fixed. Okay, right? This it doesn't change. Then now, what are the tax rates? There are normally three types of gain. Number one is RPG, residential property gain, and the rates are, look at here, 0 to 37,500, it's 18%. 37,500 and above is 28%. And for normal gain means all gains other than residential property gains and qualifying gains. All gains other than residential property gains and qualifying gains are normal gains. For normal gains, you have rates of 10% for first band and 20% for second band. And the last heading is QG. QG means qualifying gains. Qualifying gains means those gains which are eligible for entrepreneur relief. So they will have a flat tax rate of 10%. Right? Okay. Now, two very important things. Open your eyes. Order of tax computation. It is possible there is a guy who is doing job, who has interest income, that means non-saving interest, dividend, all incomes, and that guy also have some gains. So how will we compute tax? What is the order? The order is always order of tax computation. Look at here. First of all, compute tax on non-saving, then interest income, then dividend income, then QG, qualifying gains, and finally RPG or NG in any order. RPG or NG in any order, that's your wish. The answer will remain same. Okay, so non-saving, interest, then dividend, then qualifying gains, and then finally RPG or NG in any order. RPG or NG in any order, right? Okay, now for example, you have in one fiscal year you have three gains. In one fiscal year you have RPG, you have NPG, NG, and you have QG, and you have only one annual exemption. We all know for one fiscal year there is only one annual exemption, that is 12,000 pounds. So now how can we use that annual exemption? How can we use that annual exemption? Listen, there is a priority, there is an order which you have to follow. Number one, always use annual exemption for RPG first, then NG, and then QG. This is the order. This is the order of utilization. This is the order of utilization annual exemption. This is the order of utilization annual exemption. Okay, now let's move on to the first relief, that is entrepreneur relief. Entrepreneur relief, first of all, look at the screen very carefully. Entrepreneur relief is only for individuals, it's not for companies. Okay, and there are two, in my class I always say there are two separate tunnels, there are two slides. Have you seen slides in water park? There are two separate tunnels, there are two separate slides for entrepreneur relief. Whichever slide you will use, you will go to the destination directly. The first slide is very easy. Sale of running business or part of running business. See the word running business. Running business, you just sold your running business, plus holding period of business is equal to 24 months. The date you are selling, it's that business is 24 years old, 24 months old with you. That means your period of ownership must be, for that business must be 24 months. If you satisfy these two conditions, you are eligible for entrepreneur leave. Then the gains on this transaction, then the gains of these transaction will be qualifying gains. Okay, there is a second tunnel as well. 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 See, and that second tunnel is sale of shares. Sometimes you get entrepreneur relief on selling, by selling shares, come on, come on, come on, look at me. Number one, what are the conditions for shares disposal, disposal to qualify for entrepreneur leave? Number one, the shares of the company must be of trading company. Number one, that company for which you are selling the shares must be trading company, the first condition. Number two, holding must be greater, your holding percentage must be greater than 5%. 5% holding must. Okay, employee of that company, you are doing job in that company, you must be doing job in that company, you are a director or you are an employee, sales manager of that company. And last condition, holding shares for last 24 months. Holding shares for last 24 months, you must be holding those shares for last 24 months. Okay, for example, you bought shares today and you sold after 10 months, no entrepreneur leave. After 12 months, no entrepreneur leave. Minimum 24 months is must. And you know, this is the one of the favorite area of examiner. He plays with the students, he misses one or two conditions and then he says, do we apply entrepreneur leave or not? So you have to check. Okay, so these are very small tiny things, little things to learn. So these are the two tunnels. Now one more thing is, sir, is there any lifetime limit? Sir, is there any lifetime limit for entrepreneur relief? Yes, 10 million gains in your life. What in anybody's life, one guy can only claim maximum 10 million gains. 10 million gains entrepreneur relief. Once you have used your limit, then if you apply all conditions, you won't get a single relief. Okay, now, sir, what is entrepreneur relief? What is entrepreneur relief? Those gains who qualify for entrepreneur relief, they are taxed at flat rate of 10%. Flat 10% rate. Okay. Now, this is one extra thing. Claim date. Now, what do you mean by claim date? The question, I say this in my class, The question is how examiner will come, how tax department will come to know that you need this relief. How tax department will come to know that you need this relief. So you have to say, you have to write a letter, you have to do election, you have to do claim, you have to claim that, sir, yes, 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 I want this relief. So there is expiry date, there is a last date of claim. So now our fiscal year is 1920. If you have qualifying gains in 1920, then the claim date for entrepreneur relief is 31st January 2022. You must claim entrepreneur relief before 31st of January 2022. Okay. Now, one very interesting topic, that is investors relief. This is a very new relief, and this is applicable from this current fiscal year, right? Uh, if you are active, if you are turned on, then you can see for entrepreneur relief tunnel number 2, entrepreneur relief tunnel number 2, you must be the director, you must be the employee of that company. Then that means you are holding shares plus you are working for that company as well. So what government did, UK government extend this relief for external investors. See, for external investors means if you want to claim investor relief, you don't need to do job in that company, you don't need to do job in that company. Now be very careful, these are important conditions. Now, number one, shares from unlisted trading company, the company must be trading company. Subscribe for, that means, wait, you can't buy these shares from stock market. If you want to claim entrepreneur relief, you cannot buy those shares from stock market. You have to buy those shares from directly from the company. That means initial subscription, initial subscription, like we say it IPO or something, right? And you must hold those shares 3 years. Look at here, you must hold those shares 3 years after 17th March 2016. No matter you bought before 17th March 2016, it's not an issue, but you have to hold these shares 3 years after this 17th March 2016. And if your mind is working, then just add 3 years, just add 3 years after 17th March 2016, so it will come 17th March 2019. And 17th March 2019 means our fiscal year. 17th March 2019 means the close to our fiscal year. That's why this topic is applicable from this fiscal year, right? No need to do job in that company. And see the screen, there is no requirement of 5% holding. In entrepreneur relief, the 5% holding requirement was must, the job requirement was must, but right now here there is no job requirement. Okay, so if you meet these conditions, but don't forget the holding period here is 3 years after 17th March 2016, 3 years after 17th March 2016. Sir, what if we meet all these conditions? Sir, what if we meet all these conditions? So how we gonna calculate the tax on this investor relief? Same flat 10% rate, same flat 10% rate, like QG. Now students will ask, sir, for QG, for qualifying gains, there was a limit of only 10 million. Here you have a separate read, but a separate 10 million lifetime limit is available. So entrepreneur relief 10 million limit is separate, and investor relief 10 million limit is separate. Both are separate limit, but once you used it both, then you are not eligible for these reliefs. Okay, so don't forget to read this. This is coming nowadays. Many students are saying in last attempt this they also tested this. Now, hope you remember the rollover relief and frozen gains. Rollover relief, yes, it's a technical topic, but I will try to sum it up. Okay, rollover relief. What is rollover relief? Sometimes you sold a business asset and then you reinvest in another business asset. So government says if you reinvest, means you don't go take that money out from the business and you are not spending on your family, you are spending on the business. So you will be eligible to defer your gain, you will be eligible for defer your gain. So there were two types of relief in this. Number one is rollover relief, and number two is frozen gains. Sometimes you freeze your gains. Okay, when do we apply rollover relief? In rollover relief, you look at here. In rollover relief, you reduce the base cost of new asset, you reduce because you sold existing asset, you buy a new asset. So in the rollover leaf working, you reduce the base cost of replacement asset. But in frozen gains, case, you never reduce the base cost of new asset. Now, sir, next question. Sir, when do we apply rollover leaf and when do we apply frozen gains? Look at here. Always see the replacement asset. If the replacement asset is a non-depreciating asset, then you have to do rollover working. If the replacement asset is non-depreciating asset, then you have to do rollover working. And if the replacement asset is a depreciating asset, then you have to go for frozen gains. Then you have to freeze the gains. Now, one last thing, sir. If we freeze the gain, then when this gain will be taxable in future? Because these both reliefs are deferral reliefs. If we freeze our gain, when we gonna tax in future? There are two dates. The first date, look at here, the first date is disposal date of that replacement asset, and the second maximum 10 years. Whichever date will come early, you need to pay the tax on frozen gain on that date, right? Okay, now wait, the question is, sir, can you tell us the few depreciating assets of our TX F6 course? Yes, learn these two names. Number one, plant and machinery. If you are buying a plant and machinery, or if you are buying a leasehold property with lease term 60 years or less. If you're buying a leasehold property with lease term 60 years or less, then these two are depreciating assets, and for that you have to work frozen gains working. No more rollover, only frozen gains working. Now, see, I've made some summaries for you. Listen, for rollover, replacement asset is equal to non-depreciating asset, must be non-depreciating asset. For frozen gains, replacement asset must be depreciating asset. How do we work out rollover? In rollover, base cost of replacement asset will be reduced. In rollover working, base cost of replacement asset will be reduced, and in frozen gains, base cost of replacement asset not to be reduced. Okay, I hope you studied these things. Now, there is one more business relief which is called gift relief. Which is called gift relief. Now, look at here. For example, connected person, the family members, connected person, father, son, father, daughter, mother's daughter, these all are connected person. And when we have seen in our life, when there is a transaction between connected person, people give their chargeable asset free of cost. So what's the rule of tax department? They say, then whenever a chargeable asset is transferred from dad to son, from mom to son, you have to use market value to compute the gain. That means, instead of disposal proceed, use market value. Look at me, look at the screen. For example, mom bought the asset for 10 pounds, but right now the market value, after 2 years, the market value has been appreciated to 50 pounds. Okay, and mom gave free of cost to his son. Now, just think, in the mom's period of ownership, the asset is appreciated from 10 to 50. The asset has been appreciated from 10 to 50. So that means this 40 appreciation is the responsibility of mom. Mom will be taxed on this 40 gain. Okay, so now come here. See the first question. For example, dad bought an asset for 10, and now at this date, please look at here, he transferred his son this chargeable asset free of cost. Consideration is 0, but the market value is 50. Now, how do we compute the gain? First, for dad, this working I'm doing for dad. Okay, we use, instead of DP, we use the market value. So the DP is 50 and the cost is 10. The cost is 10. So here you have gain of 40. You have gain of 40. Now let us say this dad and son elected to defer gain through gift relief. Yes, they can claim gift relief because let us say this is a business asset. So right now what you do, you will deduct less, you will write GR 40. So there will be no tax on dad, but the in future son will be responsible for the tax. Now the student says, sir, how? See, base cost of asset for son will be reduced. Son just got the asset with a market value of 50, and what is the gift relief? The deferral amount is 40. See, I've just reduced 40. So the base cost of asset for son is 10. Now just think, when you have reduced the base cost of asset for son, so automatically future gains for son will be increased. Now just for this topic, I'm giving you some logic. Sir, what is the advantage of gift relief? What is the advantage of gift relief? Listen, see, dad transferred the business to son and there is no tax in the family. There is no immediate tax on the family. In this way, the business will be transferred to new young generation. Otherwise, old people have to sit over the business. So government wants the new blood to come in the business. So now in this way, dad will transfer the business to son and there is no immediate tax to the family. And if son disposes this asset in future, then he has to pay the tax. So see, in this way the business activity in UK will be promoted. Now one quick recap. For example, in this case, this transaction was a pure gift. Why? Dad did not charge a single penny. Market value 50 and consideration 0. What if? If in the same question it is written that market value is 50 and dad sold asset to son for 35. Market value is 50 and dad sold son the asset for 35. So look at here. In this case, you have to calculate the gift element. So 50 is the market value and the consideration is 35. So automatically the gift element will be 15. And in that case, when the gift element is 15, so your gift relief will be restricted to the amount of gift. That is 15. This thing I'll be discussing in the question. Let me come to the question, so I'll discuss this case with you guys, don't worry. Okay, and one more thing, things are already written because my hand is broken. That's why if I'm doing a little right now, my writing is not that much good, okay, because I can't hold the pen properly. But 99% things are ready-made written, so don't worry. But whenever I need to write, my writing will not be good. That's why, because of the broken hand. Now, conditions for gift relief. Sir, are there any conditions for gift relief? Obviously, you have to meet the first thing. If dad is giving any asset, so that asset must be business asset. In the hand of donor, right? Okay, a factory or something like. And second case, if dad is giving shares, then if dad is giving shares of unlisted trading company, then no holding percentage is required. No need to check the holding percentage. But if dad is giving quoted companies shares, then minimum 5% holding by donor is must. Holding by donor is must. And in many past paper I have seen that examiner makes a question, all conditions are satisfied for gift relief. He motivates you even for gift relief, but in the end it is written that this is quoted company and your holding is only 1%. it is quoted company and your holding is only 1%. So that means, my dear boys and girls, you are not eligible for gift leave. So you have to calculate gain, but in the end you can't defer the gain. You can't defer the gain. So don't forget to see these holdings. This may cost you a lot. Now, one more thing, very little topic. How to compute market value of quoted shares. Now just think, if there is a transaction between connected person, if there is a transaction between connected person like mom, son and all, so instead of dp we have to use the market value. Instead of dp we have to use the market value. Now sometimes mom gifted shares, quoted company shares to his son. Okay, so in that case you need to calculate the market price, the market value of that quoted company shares, the market value of that quoted company shares. How to calculate the market value of that quoted company shares? Listen, it is now very simplified. It's just the mid quoted price. It's just the mid quoted price. You will be given the lowest and highest quoted price. You will be given the lowest and highest quoted price. You just have to calculate the mid value. So for example, in my screen you can see 10 is the lowest and 12 is the highest. So what is the midpoint? Between 10 and 12, the midpoint is 11. So in that case, you have to use the market value as 11 pounds. Okay. So this is just a one step, very single step. This will be used for the computation of gain. This will be used for the computation of gain. Now, a very detailed big relief. You must have remembered PPR. UK government knows this thing. UK government UK government knows this thing, that every human, you, me, we all want one house, one shelter. We want one house to live. Okay, so what they made the law that, okay, buy one house for your living, for your residence purpose, and if you buy it and you use it for residential purpose, and if then you sell it, so no need to pay any tax on it. Okay, and that's definitely our need. We all need one house. We all need one house. Okay, so if you buy a house and you use it, you occupy it, and then you sell it, okay, no tax. Now the second topic is deemed period of occupation. Now listen, UK government also knows this thing, that sometimes our private residence, we also leave our private residence. We also leave our private residence for, we are human being. We have to leave our house. Let us say we have to go for vacations. We have to go for marriage or our cousin's wedding. We have to go for job in other country. So these are human requirements. Human. So what government has said, if you leave your house for ABC, if you leave your house for ABC, still you will get the relief. So the first thing is A, 36 months without any reasons. First relief, point number 8, 36 months you can go anywhere without any reason and you will get exemption. Even the tax commissioner won't ask a question from you. Okay. B point, any period, unlimited time period of employment working abroad. If you are going abroad for job, so no matter you go for 10 years, still you'll get the relief. Number C is only 48 months. Don't forget, C is only 48 months of working elsewhere, and it's for employed and self-employed. Employed and self-employed both. What do you mean by employed and self-employed? Means you are going for job, still it's okay. If you are going for business, still it's very okay. Sir, what is the difference between point B and C? Open your eyes, boys and girls. What is the difference between point B and C? For point B, abroad is must. You have to go abroad. For point C, no need to go abroad. Within UK is also good. For point B, there is no time limit. For point C, maximum relief is available 48 months. After that, there will be no relief. For point B, you have to go for job, employment. For point C, you can go for job as well as for your business, right? Okay. So don't forget. Now the real point, this deemed period relief, ABC, look at me. This ABC relief is only available when you make a sandwich. Look at my screen. My video is on. This ABC relief is only available when you make a sandwich. Sir, what do you mean by sandwich? Have you seen the sandwich? When this absence period is covered by actual period of occupation. That means you are living before leaving the home, you are living in the home, and after that, again after this absence period, you are again present in the home for at least 1 month. That means the two layers of sandwich. You are actually, the house is actually occupied by you before leaving, and after this absence period, again you are in the house. Okay, then you will be eligible for this ABC. So don't forget this. I in my class I shout, I announce openly, ABC is only available when you make sandwich, when you make sandwich. Now there is one more relief. Hope you remember. Last 18 months are always exempt. Last 18 months are always exempt. And don't forget, when there are many students who do these questions with timelines. There are many students who do these questions with timeline. So how I always say that the selling date, the disposal date extend 18 months from disposal date, and that is always exempt. That is always exempt. Even you are living in the house, not living in the house, you are making sandwich or not, in all condition last 18 months are exempt. But let me give you a disclaimer. Last 18 months are only exempt if you have used this house at least 1 month in your life for private use. In your life for private use, last 18 months is exempt, yes, but there is a little condition. At least for 1 month you have used this house in your life for residential purpose, right? So you will get. Now let me give you a quick recap. See, if you live in the house, if you stay in the house, this is called actual period of occupation. This is exempt. This is exempt. If you leave your house for ABC, if you leave your house your ABC with sandwich, if you leave your house with for ABC with sandwich, still you will get the relief. Still you will get the relief. And last 18 months are also always exempt. Last 18 months are always exempt. Okay. Now, boys and girls, look at here. There is one more relief which is connected to this chapter. There is one more relief which is connected to this chapter. After this leave, I'll give you a short break. Okay, I know you guys are tired. Letting relief, letting relief. Now the first thing, sir, how can we claim letting relief? What is the identification? What is the identification that with PPR relief we have to calculate letting relief as well? Listen, don't forget absence. There are two types of absence. One is deemed absence period. Deemed absence means ABC and last 18 months, ABC and last. And second one is chargeable absence period, which are not exempt months. Okay, now look at here. Let us say you are leaving your house. That means you are absent from your house, and that absence period is chargeable absence period, and you are letting your house in the chargeable absence month. Then you are eligible for letting relief. Repeat, whenever you let your house in the chargeable absence period, then you are eligible for letting relief. Sir, if we let our house in deemed absence period, then no, then no letting relief, because deemed period itself is a relief. In deemed period you are already getting a relief, so no more extra relief, okay. So letting relief is only available, only available when you let your house in chargeable absence period, when you let your house in chargeable absence period, okay. Now I hope you remember these three columns. That's how we do. This is total months, exempt months, and chargeable months. Okay, I've just given an example. Okay, now see, what is the formula of PPR? The formula of PPR is gain multiplied by exempt months divided by total months. Gain multiplied by exempt months divided by total months. Now, how we calculate letting relief? This is the formula for letting relief. Always for letting relief you have to calculate three things. Always for letting relief you have to calculate three things. The first thing is PPR, which you have already computed, just copy paste. Number two, this is important, gain attributable to chargeable absence period. Okay. And number three, the third line is maximum 40,000. Calculate these three numbers, and whatever number is the lowest number is your letting relief. Whatever number is the lowest number is your letting relief. Okay. Okay. Now, let me tell you a complete format, a complete, total complete format of PPR question. How to deal with a complete PPR question. Look at here, look at here. First of all, you have to write. First of all, you have to write disposal proceed, disposal proceed. Then deduct the cost. Then deduct the cost. You will get gain before PPR. First of all, you will get gain before PPR. Now calculate PPR. How to calculate PPR? PPR is equal to gain multiplied by exempt months divided by total months. PPR is equal to gain multiplied by exempt months divided by total months. Here you go, the PPR. Okay. Then you deduct PPR, you will get gain after PPR. Now, wait. In my class, I often say that whenever you come to gain after PPR, just apply the brakes. Gain after PPR, apply the brakes and think, then think. Whether you have, do we have to apply letting relief or not? Gain after PPR, brakes up, apply brakes, and then think, do we have to apply letting relief or not? Do we have to apply letting relief or not? Wait, what is the identification? What is the identification? The identification is we only apply letting relief, we only calculate letting relief when when letting is done, when letting is done in chargeable absence period. When letting is done in chargeable absence period. Okay. Then if letting is done, yes, you get green signal in chargeable absence period, then write letting relief. And letting relief is the lowest of these three. Letting relief is the lowest of these three. Just compute it and deduct it. Just compute it and deduct it. You will get final gain. You will get final gain. You will get final gain. Okay. Check it. That's your format. That's your final format. Okay, guys, we are taking a short 5 minutes break. 5 minutes break, and then I'll be joining you shortly in 5 minutes. Okay. Okay. Welcome back. Welcome back. Now, there is a topic which is capital losses. There is a topic named with capital losses. Look at here. Disposal proceed less cost. If DP is higher and cost is lower, you get gain. And if DP is lower and cost is higher, you get loss. Okay, you get loss, not get lost. Uh, so listen, in bad days, that means in losses days, tax department gives you relief. What is the relief? The rule number one. If you have in one fiscal year, there is one capital gain and one capital loss. In one fiscal year, there is one capital gain and one capital loss. They just set off each other without your permission. They don't take your permission. They set off. Even in this case, see, I've written there is no planning. There is no planning in this case. Same year gain and same fiscal year loss. They don't take your permission. They just net it off. Even sometimes because of this net off, you may lose your annual exemption. You may lose your annual exemption, right? Now, what if, just think, you have a capital loss of 50,000 and capital gain of 30,000. 50,000 capital loss and 30,000 capital gain, they both will set off each other. Still you have unused capital loss of 20,000. Now what you will do with this unused capital loss, you will carry it forward this unused capital loss for future, but strictly unused capital losses will set off future gains only, no other incomes, only gains, right? But there is a good news. When, just look at me, when you have brought forward capital loss from last year, then now you can do planning. What is the planning? Brought forward capital loss should be used in that style that you don't waste your annual exemption. You don't need to waste your annual exemption. Okay, so be careful. Current year capital loss, no, it's no planning, it just set off your gain. But brought forward capital loss, you have to do planning. And in brought forward capital loss, you must use your capital loss up to the extent that your annual exemptions are not to be wasted. So be careful. Now, there is one very short topic in your capital gain topics, that is chattels. Chattels means tangible, tangible movable property, like your cell phone, tangible movable property, your plates, tangible movable property, paintings, tangible movable property, jewelry, tangible movable property, right? Okay, so now what are the rules? There are tax department has divided, open your eyes, tax department has divided chattels into two categories. The first types of chattels are called wasting chattels, and the second types of chattel are non-wasting chattels. One is wasting chattel and second is non-wasting. What is wasting chattel? For which the useful life, the expected life is less than 50 years. The expected life is less than 50 years, right? Sir, what is the treatment? What is the treatment for wasting chattels? Wasting chattels are exempt. Wasting chattels are exempt. That means they are exempt asset. No need to compute any capital gain or losses. But yes, only in one condition they are taxable. See this. They are taxable. See this, please. They are taxable only if used in business. If used in business and capital allowance is claimed. If you are using that wasting chattel in the business and you are claiming capital allowance, then you have to do working for it. Okay. Now, the second type of chattels are called non-wasting chattels. The second type of chattels are called non-wasting chattels. Okay, obviously non-wasting chattel means life more than 50 years, expected life more than 50 years. So normally they are antique items. Some students ask, sir, can you give some example for antique items? Yes, I always say, go to your home and ask your mom. She must have some jewelry of grandma, or like, so that's easily more than 50 years. Okay, so for non-vesting chattels, antique items are there, and there are four special cases for non-vesting chattels. Now, open your eyes. The real topic of chattels starts now. See, these are the four cases. These are the four cases you can see on the screen. Case number 1. If the cost of that non-vesting chattel is less than 6,000 and DP is also less than 6,000, if cost is less than 6 and DP is less than 6, then no gain, no loss. Nothing, do nothing. Then do nothing. If cost is less than 6 and DP is also less than 6, then just ignore it. You will get masked by ignoring it. Okay. Case number 2. If cost is greater than 6,000 and DP is greater than 6,000, if cost is greater than 6,000 and DP is greater than 6,000, then do normal CGT working. For example, wait, you bought a non-vesting chattel for 10,000 pounds and you sold it for 15. You bought a non-vesting chattel for 10,000 and you sold it for 15. So the difference is 5,000. Just normal gain, the way you do it. Now, case 3 and 4 is different and you have to learn few things in it. If cost is less than 6,000 and DP greater than 6,000, if cost is less than 6 and DP greater, then chargeable gain will be lower off. Then chargeable gain will be lower off. See, first do normal gain working. First do normal gain working, and then second apply this formula: cross DP less 6,000 multiplied by a fixed fraction of 5/3. I repeat. If cost is less than 6,000 and DP is greater than 6,000, then open your eyes. Then you must be alert. Then you have to do two workings. The first working is normal gain computation. And the second working is this gross DP. This is the formula: gross DP minus fixed 6,000 multiplied by 5/3. Now compare these two amounts. Whatever will be the lower amount, that will be your chargeable gain. The lower amount will be your chargeable gain. Now, case 4. If cost is greater than 6 and DP less than 6. If cost is greater than 6 and DP less than 6, that means it's a case of loss. For example, cost is 9,000 and DP is 4,000. Cost is 9, DP is 4. Okay, so definitely you can see the loss. Now how to compute loss in this case? Any very important words: any capital loss will be computed using deemed DP of 6,000. You don't need to use actual DP. You have to use assumed DP. Deemed DP of 6,000. Use deemed DP, and the cost is actual. In this way, you know what will happen? Your loss will be reduced. Okay, so in case 4, no need to use actual DP. Just use this deemed or assumed DP. Okay, now the final words, very important words. The past paper says examiner never uses the word chattel. It's your responsibility to recognize that the question relates to chattels. They will give you hint. They will say the car. They will say the word paintings. They will use the word chair. Chair is tangible movable property. Then you have to recognize yourself. They normally never use the word chattel. So don't expect that they will tell you ready-made name of chattel. You have to be alert. Okay, this is a skills module paper. Very interesting topic. Transfer of chargeable asset between married couples and civil partners. Transfer of chargeable asset between married couples and civil partners. Now, for example, just look at the screen. You will understand. Mr. A and Mrs. A. Mr. A bought an asset for 10. And he transferred this asset to her wife when the market value was 50. Now, write it on in your heart that the transfer between husband, wife, and civil partners, this transaction is nothing. Just ignore it. This is a no gain no loss transaction. Sir, what do you mean by no gain no loss? No gain no loss means gain or loss zero. That means husband transferred the asset to wife cost to cost. That means DP and cost is same. So whatever will be the cost of husband will become the cost of wife. Now This asset has come to wife. Now finally, after a few months, wife sold it to third party for 80 pounds. Wife sold it to third party for 80 pounds. Boys and girls, can you tell me what will be the final gain to wife? What will be the final gain to wife? The final gain to wife will be 70 pounds. 70 pounds, because the cost to wife is 10 pounds. The cost to wife is 10 pounds and the DP for wife is 80 pounds. Okay. Okay, so always whenever husband wife or civil partners, there should be a click in your mind: no gain no loss between husband wife transaction. No gain no loss. Okay, and the husband cost will become the wife cost. The husband cost will become the wife cost. Now one more important event nowadays coming a lot. This is the death issue. See, the death issue. Transfer of chargeable asset at the time of death. Transfer of chargeable asset at the time of death is exempt from CGT. Is exempt from CGT. No CGT on it. For example, Mr. A bought an asset for 10 pounds, and after 3 years he died. At the time of his death, the market value was 100. The $10 cost and the market value is 100. And in his will, it is written that that transfer this asset to son. Now, at the time of death, or you can say after death, whatever asset will be transferred, there is no CGT computation, no CGT computation. And the good news is that the market, read the lines, market value of asset at the time of death becomes the base cost of asset for son. Don't forget. So there is a planning point here, because tomorrow we will be doing IHT as well. So you all are students and you must have studied this thing, that for CGT point of view, it is good, it is best to transfer asset at the time of death, not in the life. Because at the time of death, when you transfer any asset to son, daughter, or anybody, there is no gain no loss. There is no CGT, there is no CGT. And the market value becomes the market value at the time of death. Market value of asset at the time of death becomes the base cost of asset for son. Okay, now let me give you a very interesting recap of this topic. See, the name of this slide is interesting. Now wait, all of you, please be active, be very active, you will enjoy it. The story starts with the grandfather. Obviously grandfather comes first and the grandson comes afterward. Please, the story starts with grandfather. Let us say the grandfather bought an asset, chargeable asset, for 10 pounds. Look at here, boys and girls. The grandfather bought an asset for 10 pounds. Now grandfather transferred this asset to grandma, the wife of grandfather. At that date the market value was 50. So you just cross it, that grandfather and grandma are husband wife, grandfather and grandma are husband wife. And whenever there is a transaction between husband wife, we just close our eyes, we say it: no gain no loss, no gain no loss. And the cost of grandfather will become the cost to grandma. See, okay, so now the first step has been done. The asset has been transferred to grandma. The cost to grandma is 10, same cost, huh? Ignore the market value. Now after some time, after a few years, grandma passed away, and this is a natural problem. We all have to leave this world. Now at the date of grandma death, the market value of this asset is 80. And according to the grandma's will, the will says that this asset to be transferred to grandson. Okay, so at the time of death, this asset is to be transferred to grandson. Now at the time of death, there is no CGT, applications. And what happens? Look at here, the market value of asset at the market value of asset at the date of death becomes becomes the base cost for grandson. The market value of asset at the date of death becomes the base cost for grandson. Okay, now the asset has come to grandson. Okay, now after few years, grandson transferred this asset to his wife. Okay, at that time the market value is 150. Again hazard lights, hazard lights. Grandson and wife, the transaction between husband wife, the transaction between husband wife is no gain no loss. The transaction between husband wife is no gain no loss, and the base cost of this husband, that means grandson, becomes the great base cost for wife. Okay, so finally this asset with this young lady, this asset is with this young lady, the wife of grandson, and the final cost is 80. And in the examination it is written CCC, that finally this young lady, this wife, sold this asset to third party for 250. So can you tell me, can you guys tell me the final gain for wife? Can you guys tell me the final gain for wife? This final gain will be 250 minus 80. 250 minus 80, this becomes around 170. 170 will be the final gain. Okay, okay. Now whenever I teach in my whole last 15 years, whenever I teach this topic, I give one disclaimer. See, I told you the story from forward story, from grandfather to grandson wife. But you know, when it comes in exam, examiner gives reverse story. Examiner says that wife sold the asset, he got the asset from this from his husband, and that grandson inherited this asset from grandma. Reverse story. So the reverse story is difficult. Right now I told you story in a very easy form, so don't expect the same easy format in exam. Plus I taught you with the sketch. In exam you won't be getting any sketch, you will getting a word problem type question. So be very careful with the exam. Giving you 30 seconds, just look at it, look at this thing. Okay, now we are very close to our questions. Now this is a topic which is called shares and securities. There is a topic which is called shares and securities. Whenever an individual, look at here, whenever an individual sells or gifts shares, you have to use this format. For computing gain. First of all, you'll write DP, and with the disposal proceed you have to match the cost. So how to match the cost for shares? This is the matching order rule. See, always follow these matching order rules. What is the priority? Look at here. Number one, same day purchase. Just check whether on the disposal date, did you buy any shares on the same date? If yes, then use that cost first. Same day purchase, this is the first thing. Then number two, following 30 days purchases. Following 30 days means from disposal date, future 30 days. If there are any purchases in future 30 days, use that cost. And the last thing is cost from weighted average shares pool. You have old shares before disposal date, you must have bought old shares. So from that weighted average share pool you have to take out the cost. These are the three steps which you must have to follow in order to compute gain of shares and securities. And this is for individuals. Okay, this is for individual. Whenever an individual sells shares or gift shares, we compute gain. Yes, and in that gain computation, DP is ready-made given. DP, disposal proceed, is ready-made given. And for cost, to match the cost, you have to follow these rules. That is same day purchases, following 30 days purchases, and then shares from weighted average pool. Okay, then you will get gain or loss. Okay, one more thing. This is the priority which I just told you. Same day purchase, following 30 days, and then shares from pool. cost of shares from pool. What if in your question there is no same day, then leave it. There is no following 30 days, then leave it. Okay, but this is the order, this is the order, this is the priority which you must follow. Now there is one little topic which is called right issue and bonus issue. There is one little topic which we call it right issue and bonus issue. Okay, for example, Mr. A is the shareholder of X company. Mr. A is the shareholder of X company. Open your eyes. And Mr. A bought 10,000 shares on 1/1/010. Look at here. On 1/1/2010, Mr. A bought 10,000 shares for 20,000 pounds. So once you buy share in any company, you become shareholder. Once you buy shares in any company, you become shareholder. Okay, now let us say after 5 years, see this date is 1/1/2015, this date is 1/1/2015. This X company offered a right issue. This X company offered a right issue of 2 for 5. Look at here. This X company offered a right issue for 2 for 5. Okay, so obviously right issue offer is given to all shareholders, so Mr. A will also be getting this offer. Now let us say in the question it is written that Mr. A subscribed these shares. Now 2 for 5, 2 for 5, do it. 2 upon 5 multiplied by 100, it's a 40%. It's a 40% right issue. Now how will you update, how will you incorporate in your exam? You already have 10,000 shares. You already have 10,000 shares. 10,000 times 40%, new shares will be 4,000 shares. Okay, and obviously we all know that right issue is not a free issue. You have to pay it. You have to pay it for right issue. So for example, you paid £3 per share. So you just bought 4,000 right shares, and multiply by 3 is 12,000 pounds. So here you will write 12000. Okay, right, and you'll update the pool. So don't forget, right issue is an issue with money, you have to buy it. Okay, so in case of right issue, you have to update both columns. In case of right issue, you have to update both columns, the number of shares column plus the cost column, the number of shares column plus the cost column. Okay, now one very easy thing. Sir, what if we get the bonus issue? What if we get the bonus issue? We all know this thing, that bonus issue is a free issue. Bonus issue is a free issue. So we get free shares. So if it is written bonus issue, then what you have to do, look at the screen. You just have to update the number of shares column, and you have to write dash. You have to write dash in the cost column, because you're not paying anything for bonus issue, right? So the slight difference: in right issue you will update both columns, and in bonus issue you will be updating only shares column. Okay, now there is a topic, paper to paper takeover relief. I have tried to solve it maximum, but still I'll solve it for you, because this knowledge you must know. Listen, look at the story and be very active now. Mr. A purchased 10,000, or see, this is the starting of the story. Mr. A purchased 10,000 ordinary shares of X company. See, this is the X company. Few years back, let us say 3-4 years back. Okay, so Mr. A is the existing shareholder. Open your eyes. Mr. A is the existing shareholder of X company. Okay, now after 3-4 years, let us say today, Y company wanted to take over X company. Y company wanted to take over, wanted to acquire X company. So whenever one company wants to acquire another company, they need shares, they need ordinary shares. So Y company offered all the shareholders. Y company gave the deal to all the shareholders of X company, and this is the deal. See, this is the deal. This is the real deal. What is the deal? Whoever will give one ordinary share of X company, whoever will give one ordinary share of X company to Y company, in return Y company will immediately give two things: two ordinary shares of Y company and one preference shares. Two ordinary shares of Y company and one preference shares. Okay, so just think, Think it practically. At the time of takeover, obviously Mr. A also received this offer and Mr. A accepted it. Mr. A accepted it. Now, how many ordinary shares? How many ordinary shares will Mr. A get? One for one ordinary share of X, double. Two ordinary shares of Y will be given. So Mr. A has 10,000 ordinary shares. Mr. A has 10,000 ordinary shares. So 10,000 multiplied by 2. See, 10,000 multiplied by 2, 20,000. Mr. A will get 20,000 ordinary shares and Mr. A will get 10,000 preference shares because preference deal is 1 for 1. Preference deal is 1 for 1. Okay. Now, be very careful. Mr. A gave Mr. A gave his existing shares and he got new shares, two types of new shares. So Mr. A called tax department immediately. Sir, do I have to pay? Do I need to pay any tax? Do I need to pay any tax? Tax department said, no, 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 you don't need to pay any tax because you didn't get any cash. Because you didn't get any pay any tax. But yes, do one thing. Existingly you have only one type of shares, ordinary shares. In past you had only one type of shares, that was ordinary shares, but now you have given your ordinary shares and you have two different class of shares. You have given your ordinary shares and you have two different class of shares. One is preference and one is ordinary. So you need to split this cost between the new shares. You need to apportion this cost between your new shares. So I immediately asked a question from tax department. For apportionment we need a base. For apportionment we always need a base. What will be the base? So tax department guy immediately replied to me, use the market price of Y company shares at the date of takeover. Use the market values of Y company's shares at the date of takeover. See, the market value is given. Market price per ordinary share of Y company at the date of takeover is £4. Look at the screen. And market price per preference shares of Y company at the date of takeover is £2. Okay, so let's compute the market value. See how many ordinary shares we got. We got 20,000. Look at here, we got 20,000 ordinary shares of Y company, and the one ordinary shares, the cost of the market price of one ordinary share is £4. So 20,000 times £4 is 80,000. 80,000 is the market value. 80,000 is the market value of ordinary shares. And how many preference shares we got? 10,000 preference shares multiplied by the share price. The share price of one preference share is £2. So 10,000 times 2 is £20,000. Now what you do, just simply add these market values. This will become 100,000. Okay, now do you know how to calculate it? This 100,000, just take it as 100%. This 100,000 is 100%. Now can you tell me the weightage of ordinary? 80,000 market value is the ordinary market value. 80,000 divided by 100,000. 80,000 divided by 100,000 will give you 80%, and 20,000 divided by 100,000 will give you 20%. Okay, so the percentage split is 80 and 20. The percentage split is 80 and 20. Now final thing, look at here. Final thing, original cost was 40,000. You just have to split 80% and 20%. Look at here, what is 80% of 40,000? This is 32,000. This is 32,000, and 40,000 times 20%, this is 8,000. Okay, so you have calculated, you have apportioned the base cost. You have sorry for the writing because the hand is broken, really sorry. Listen, for 32,000 is the base cost of 20,000 ordinary shares of Y company, and 8,000 is the base cost of 10,000 preference shares of Y company. 10,000 preference shares of Y company. Now a common man, a normal student can ask one question: sir, why did you split this cost? Why did you split this cost between ordinary and preference? Why did you split this cost between ordinary and preference? I said, wait, just think. Maybe possible next year you have to sell only ordinary shares, or next year you have to sell only preference shares. So when you sell, when in future you will sell ordinary or preference separately, so you need a separate cost. You must need a separate cost. That's why this separation is important, because now you don't have only single class of shares, you have two different class of shares. You have two different class of shares. That's why this apportionment is must. This apportionment is must, and this apportionment is done. This apportionment is done using, look at here, this apportionment is done using market prices, market values of Y companies shares at the date of takeover, at the date of takeover. Got it? Now we are moving towards the question sessions. We are moving towards the question sessions, please. One thing, listen, if you have Kaplan exam kit, that question is, this question is present in your Kaplan exam kit as well. This question is present in your Kaplan exam kit as well, okay? Or I have already sent you this question through the handouts as well. So it's your wish. You can also see on the screen. Read this question, please. Read this question. Come on, all of you read the question. Kindly read the question. Okay, students, we are taking a short 5 minutes break again, namaz break, and then we are coming back. Okay, 5 minutes, just 5 minutes break. Okay, students. Now, dear students, now be very careful. We are doing the questions, and you have this question. If you have a Kaplan exam kit, you can search from the kit as well. And I have chosen OT cases because normally CGT, IHT, and VAT, value added tax, comes in OT case area, right? Okay. Now, listen. Let's start the question. Let's read the question very carefully. You are a trainee accountant and your manager has asked you for help regarding a client. Listen, B Neptune. On 31st July 2019, Bo made a gift to his son. Bo made a gift to his son. Okay, gift to his son. Now, after reading this, gift relief comes in my mind. Gift relief comes in my mind. Okay, Sanchi, of his entire holding, 50,000 pound ordinary, 100% holding. Okay. Wait, that means holding is greater than 5%. But again, there is no need to see the holding percentage because this is unquoted company. For unquoted company, holding percentage is irrelevant. Yes, in gift relief, if you are giving shares of a quoted companies, then holding must be greater than 5%. But this is unquoted company, so holding percentage is nothing. Don't worry. Okay. Now, yes, this is very important. The market value of shares on that date was 210,000. Why? Because dad and son, dad and son are connected person, and whenever you deal with connected person and you need to compute the gain, for instead of DP, you have to write the market value. So open your eyes, your market value will be 210,000. Your market value here will be 210,000. DP will be 210,000. Sorry. The shares had been purchased by Bo on 22nd January 2012 for 94,000. Okay, very easy, very easy. You just simply, this 210,000 is your DP, this 210,000 is your disposal proceed, and your cost is 94,000. So easily you can calculate the gain. The difference is the gain. Okay. Now, one more very important thing. Bo and she have elected to hold over the gain as a gift of business asset. Okay, so gift relief is also called holdover relief. Gift relief, examiner use the word holdover relief. Okay, so yes, they both elected for gift relief. So yes, we have to calculate the gift relief. Now, just read these 4 lines. This is enough. Now, requirement number one, we have to save. Requirement number one can easily be done using this information. What is cheese base cost in the 50,000 ordinary shares in Botune Limited? Now, listen. Dad has given shares to his son. Okay, and for the computation of gain, market value is used as a DP. Let's do it. It's already made. Wait, see, look at here. Easily you can understand. DP, see, this is disposal proceed is 210,000, which we have just saw the market value less cost 94,000. What is the gain? The gain 210 minus 94. Please be active, be very active, dear. 210,000 less 94,000. Your gain is 116. Your gain is 116. And now listen, as this the complete transaction is a gift, there is no consideration right now. In requirement number one, there is no consideration. That means this is a complete gift. That's why complete gift relief can be claimed. Complete gift relief can be claimed, and they have already elected for gift relief. So right now, we have deducted the gift relief. Now, chargeable gain for dad is zero. Chargeable gain for dad is zero. Now the question comes, sir, is this the permanently deferred, or this is a temporary deferral? It's a temporary deferral. It's not a permanent relief, it's a temporary deferral relief. So how do we do deferral things? We deduct this gift relief from the base cost, for the base cost of son. Now, son got the shares with market value of 210,000. Son received the shares with market value of 210,000. And what is the gift relief? What is the gift relief? 116 we have just deducted. So the base cost of shares for Sun is 94,000. This the base cost of shares for Sun is 94,000. Okay, so your examiner has asked you the base cost and the answer is 94,000. The answer is 94,000. Answer is 94,000. And you know the logic. Why did we reduce the base cost? Because in order to increase the future gain for Sun, because this is just a deferral, this is not permanent exemption, gift relief is a deferral relief. Okay, so this is the answer of your question number 1. This is the answer of your question number 1. Look at the screen. This is the answer of your question number 1. Now moving to question number 2. The answer of first question is A. Okay, now the second question. If Bo had instead sold the shares in Botune Limited to Chief for 160. Now in the first requirement, look at here. In the first requirement, Dad was giving shares to Son free of cost. That transaction was a complete pure gift. But now dad is giving shares to his son for 160. That means, wait, the market value is 210. And dad is charging 160. So you can easily compute a gift element. Come on, tell me, what is the gift element? What is the favor element in this? 50,000 is just the gift element. And right now 50,000 is just the gift element. So now when I will solve this, I will only deduct gift relief to 50,000. That's it. Maximum gift relief that can be claimed, is just 50,000, my dear. Maximum gift relief that can be claimed is just 50,000, my dear. Okay, so let's do working. Look at here on the sides. Come on, let's do working. See, again instead of DP we'll use the market value. What is the original cost of these shares? 94,000. So DP less cost will give you gain. Now in this case, as this is not a pure gift, dad gave these shares with the market value of 210,000 to his son for 160,000. So the gift element is 50,000. So we can only deduct gift relief up to 50,000, right? So in this case, the final chargeable gain for dad right now is 66,000. The final chargeable gain for dad is 66,000. Now the student may ask, sir, what is the base cost now for Sun? Wait, very easy. Just the Sun received the shares with market value of 210. And we always deduct gift relief, the deferral relief from the base cost. So 210 minus 50, 160,000. 1,60,000 is the base cost of shares for Sun in this second part. Okay, now let's take true and false. If Bo had instead sold the shares for 160 for each of the following, select true and false. Bo's means daddy. Bo's means dad. Dad's final chargeable gain would have been 66. True. Yes. See, dad's final chargeable gain is 66. This is very true. Bo and Chi would not be able. No, they can still claim. See, we have just claimed gift relief, but yes, a restricted gift relief. Okay, not complete gift relief, but yes, they can claim. So this is false. This is a lie. False. The base cost of the shares for Chi would be 210. No. In this case, the base cost is 160. So again, this is a lie. So it's false. So in question number two, you will have one true and the two false. Now, exam tip. questions are very dangerous. If you have just ticked a wrong box, you will get zero. You will get zero in this 2 marks. Whole complete 2 marks will be wasted. So this area, OT case area, be very careful. Be very careful before submitting any answer. Okay. Be very careful before submitting. If your one mistake will cost you zero. Now next, it's about dates. Question number 3, it's about dates, and it's normally comes, I'll tell you easily. First of all, when is the capital gain tax due dates for 1920? I hope you must have studied self-assessment chapter in your F6 paper. For CGT is always paid with balancing payment. CGT is always paid with balancing payment. And what is the due date? Let me tell you. After the end of the fiscal year, the 31st January following the end of the fiscal year. So the 1920 fiscal year ends, 1920 fiscal year ends on 6th April 2020. 1920 fiscal year ends on 5th April 2020. So which after comes after 5th April 2020, that is 31st of January 2021. See, this is the date. First, let me mark this. This is the due date for CGT payment. This is the due date for CGT payment. One more thing the examiner is asking. By what date must Bo and Chi makes the election to hold over the gain? Yes, wait. I already told you when I was teaching you entrepreneur relief that there is a claim date, there is an election date for all reliefs. So the claim date for gift relief is 4 years from the end of the fiscal year. 4 years from the end of the fiscal year in which gift is made. 4 years from the end of the fiscal year in which gift is made. Wait, what's our fiscal year? In our fiscal year is 1920. Our fiscal year is 1920, and our fiscal year ends on 5th of April 2020. So just add 4 years. Add 4 years from 5th April 2020. So it becomes 5th April 2024. So this is the correct matrix. See, this is the correct matrix in which you have to take. Okay. In this, that means the election date is, the last date of election is 5th April 2024, and the CGT due date is 31st of January 2021. 31st of January 2021. Okay. So your 3 questions done. Your 3 questions done with the data we just read. With the data we just read. Giving you 30 seconds just to look at. Giving you 30 seconds. Come on, look at and think. Please be active. Now, a little bit of text computation in this question. A little bit of text computation in this question. A little working of text computation in, listen. It is written Bo has this line. I'm reading this line. Bo has taxable income of 1920s 30,500. Taxable income means non-saving interest dividend. Non-saving interest dividend is right now 30,500, and had made a chargeable gain of sale of a painting for 20,700. Wait, don't go fast. Look at here. First tell me, painting. Is painting a residential property? No, painting is not a residential property. Is painting a running business? No. So no more entrepreneur relief, no more RPG. No more entrepreneur relief means no QG and no RPG. So definitely this gain is normal gain. This gain is normal gain NG. First think over it. Now, Bo has never made any other chargeable disposals. Important line. In this whole fiscal year, Bo didn't do any chargeable disposal. That means Bo's annual exemption is spare. Bo's annual exemption of 12,000 is still is there. Okay, right? Let's start the tax computation now. Hope you saw it. Look at here. Assuming, first read the requirement. Assuming that no other chargeable gains arising in the tax year. How much capital gain tax would Bo pay on the disposal of painting in the tax year 1920? In the tax year 1920, first of all, in the question it was given the chargeable gain. Let's convert the chargeable gain into taxable gain. Let's convert the chargeable gain into taxable gain. Your chargeable gain was 20,700. Look at here, your chargeable gain was 20,700. For every fiscal year, especially for 1920 fiscal year, the amount of annual exemption is just 12,000. So let's deduct the annual exemption 12,000. This is your taxable gain. This is your taxable gain, that is 8,700. Your taxable gain is 8,700. Okay, now you have to compute tax. Please look at here. For any individual, your first band is 0 to 37,500. For any individual, your first band is 0 to 37,500. But I told you in today's class as well, you have studied before as well. Listen, that these bands are disposable bands. These bands are disposable bands. And what is the tax computation order? What is the tax computation order? First, you have to calculate tax on non-saving interest dividend and then gains. First non-saving interest dividend and then gains. So in this question we just read that this individual has taxable income of 30,500. 30,500. Look at here. So the total capacity of first band is 37,500. The total capacity of first band is 37,500. And that non-saving interest dividend already consumed 30,500. That non-saving interest dividend taxable income would already consume 30,500. So when you are coming to CGT, your unused first band is only 7,000. Your unused first band is only 7,000. Okay, keep it in mind. Now you have to calculate tax for normal gain. This 8,700 is your normal gain. You pick up this gain. Look at me. You pick up this gain and you knock the first band. So there is only how much capacity is left? 7,000. Only how much capacity is left in the first band is just 7,000. So what is the rate of tax? 7,000. For normal gain, first band tax rate is 10%. 7,000 times 7, but 10% is 700. Now what was your total gain? Your total taxable gain was 8,700, and we have just calculated tax on 7,000. So remaining gain is 1,700, and 1,700 comes as the second band. 1,700 will definitely fall in the second band, and the second band normal gain rate is 20%. So it becomes 340. If you add these two, 700 plus 340, this becomes 1040. This becomes 1040. This becomes 1040. Okay, so that's your answer. Got it? Got it. Little more efforts is needed. Okay, now the last requirement is related to PPR, principal private residence relief. But it's very easy. Let's read the question first. Let's read the question and read it carefully, because I'll move the screen. See, what is it written? On 30th September, see, from here to here it's total PPR. From here to here it's total PPR. On 30th September 2019, Bo sold a house for 282,000. This is DP, resulting in a chargeable gain of 172,000. Thank God, one step removed. Ready-made gain is given. So you will directly calculate PPR. Ready-made gain. The house had been purchased on 1st October 2007. Now please, I'll be making a little sketch for this. We bought buying date. The buying date of the house is 1st of October 2007, and the selling date is 30th September 2019. Buying date is 1st October 2007, and the selling date is 30th September 2019. Okay, so this is the difference, is the total period of ownership. This difference is the total period of ownership. Now he occupied the house as his main residence. Very good. See, this is the hint of PPR. from the date of purchase until 30th September 2009. Wait, he bought it on 1st October 07. He bought this property on 1st October 07, and from 1st October 2007 to 30th September 2009, this makes total 2 years 24 months. The first 24 months he stayed in the house. The first 24 months he stayed in the house, and whenever you stay in the house, you get exemption. Whenever you stay in the house, you use your house for private use, for residential use, you get exemption. So these 24 months are exempt. These 24 months are exempt. Now, a very technical point. Both then moved in with his girlfriend, and the house was unoccupied between 1st October 09 to 30th September 2019. That means he didn't come back. Once he left the house, he didn't come back, and when he didn't come back, there is no sandwich. He left the house and he went to another country with his girlfriend, and then he called on phone, he sold the house. He didn't come back. That means when he didn't come back, that means there is no sandwich. He didn't come back, so there is no ABC relief. There is no ABC relief in this question. There is no ABC relief in this question. But yes, last 18 months are always exempt. Last 18 months are always exempt. Okay, let's explain you. Let me explain you through sketch. Let me explain you through sketch. Oh, please see this sketch. Can you see the sketch? Wait, let me arrange it. Yes. Listen, you bought the house on 1st of October 2007, and from 1st October 2007 to 1st October 09, these 24 months is exempt because he occupied it. Okay, from 1st of October 09, he left the house. And till 30th September 2019, he didn't come back. So these all are absence period, and no sandwich. That's why no ABC relief. But my dear student, you all know this, that last 18 months are always exempt. Last 18 months are always exempt. So from 30th September 09, just calculate the last 18 months. So this date will come to 31st March 18. These 18 months are purely exempt. Now whatever is left between 1st of October 09 to 31st March 18, you guys can calculate at home. I'm giving you a ready-made number. These are 102 months. These are 102 months. These 102 months are full-time chargeable. No more exemptions. These 102 months are full-time chargeable. No more exemptions. Okay, so I hope you remember these three columns. See, I have solved it using these three columns. This is the famous way of solving these questions. The first column is total months, the second is exempt months, and third is chargeable months. See, first 24 months as you occupied the house, in first 24 months, so it is exempt. Then 102 months are full-time chargeable because the absence period and this absence period is not covered by ABC, and last 18 months are exempt. So how you do it? You just simply add total months, then exempt months, and then chargeable months. Total months, exempt months, and then chargeable months. Okay, now look at here. Now ready-made gain was 172,000. Ready-made gain was 172,000. How do we calculate PPR? The formula of PPR is gain multiplied by exempt months divided by total months. The formula of PPR is gain multiplied by exempt months divided by total months. So this will be 50167, and this is your PPR, and that's the requirement of last question to calculate PPR. That's the requirement of last question to calculate PPR. Right? Okay. So what's the final requirement? Let's check the question number 5. How much principal private? See, this is the requirement. How much principal private residence relief is Bo entitled to the sale of his main residence? The answer is 50167. The answer is 50167. The answer is 50167. You can see. You can see. Okay. Now, listen. We are moving to the next question. We are moving to the next question, and I am giving you 3 to 4 minutes again to read that question. I am giving you 3 to 4 questions to read that question. The name of the question is alphabetic limited. Come on, come on. Give your time. Give your time. You have 3 to 4 minutes to read the question. Come on, 3 minutes you have. You have 3 to 4 minutes to read the question. Come on. I hope you read the question. Now listen. This question is related to shares and paper to paper takeover, exchange of shares, right? A little bit entrepreneur relief, right? So be careful. On 15th of October 2019, Alphabet Limited, an unquoted trading company, was taken over by XYZ PLC. Okay, who is the parent company? XYZ is the parent and ABC is the subsidiary in this case. Okay, XYZ company took over ABC. Prior to the takeover, Alphabetic Limited share capital consisted of how many shares? 100,000. C. The total number of shares issued by Alphabetic company is 100,000 ordinary shares. 100,000 ordinary shares. Under the terms of the takeover, the shareholder received either cash of £6 per share or £1 one ordinary shares in XYZ PLC for each ordinary share in Alphabetic. C. There are two options. The first option, if shareholder wants, they can take cash. They can take cash £6 per share. Cash means simple disposal. If any shareholder received the cash, that means he sold the shares. That means that's a pure disposal. And the second option is that you give away, look at me, you give away your shares your shares, your one share, and take one share for XYZ. You give away your alphabetic limited one share, and in return you will get one ordinary share for XYZ. So this is comparatively easy question. There is no preference shares. There is no preference shares. This is a very simple transaction. Okay. So as a shareholder, my dear, as a shareholder, you have two options and you can opt only one. You have two options and you have to opt only one. Okay. Now let's read the discussion about the shareholders. Let us say there are three shareholders of Alphabetic Limited. The original Alphabetic Limited, let us say there are three shareholders. The first guy is Alloy. The first guy is Alloy. Okay, one more thing. Don't forget. Okay, please alert. Please alert. Look at me. Look at me. Don't forget that the total number of shares issued to date of Alphabetic Limited is 100,000, because we have to calculate holding percentage. Sir, why do we need to calculate holding percentage? You remember in entrepreneur leave, 5% holding is must. In entrepreneur leave, if you want to claim shares, entrepreneur leave on shares disposal, you must have 5% holding. Don't forget. Okay, start. Now, Alloy, Alloy has been managing director. Alloy has been managing director. Alloy has been managing director. Great. He's doing job. He's doing job in Alphabetic since the company's incorporation on 1st of January 2009, years back. See, 10 years, 10 years. She accepted XYZ PLC cash alternative of £6 per share. What does it mean? That means Alloy sold his shares. That means Alloy at the rate of takeover, Alloy sold his share and took cash. Alloy sold his share and took cash. So from Alloy point of view, this transaction is a disposal of shares. From Alloy point of view, this transaction is a disposal of shares. Don't forget, in respect of her holding, shareholding of 60,000 ordinary shares. Very good. What does it mean? The total number of shares issued by Alphabetic Limited is 100,000, and this Alloy has this girl, this lady had 60,000. That means holding is 60%. Holding is 60%. 60% means greater than 5%. 60% means greater than 5%. So, in my point of view, all conditions of entrepreneur leave are almost met. See, the first condition, he's doing job, she's doing job. Number two, holding is greater than 5%. Number three, the shares are with her since 1st January 2009. That means more than 10 years around, and the requirement is only 24 months. Alloy had originally subscribed for 50,000 shares in Alphabetic Limited on 1st January 2009 at their par value, which is £1. Par value in UK is £1, please. So par value is £1. So originally this lady bought 50,000 shares for £1 each. For £1 each. So what is the cost? 50,000 multiplied by 1 is 50,000, and purchase a further 10,000 shares on 20th May 2010 for 18,600. Now hold. Please go slow. See, these are same company and same class of shares. These are same company and same class of shares. Same company and same class of shares are indistinguishable, and they are added in the pool. Added in the pool. See, I have made the pool for you. This is the pool for Alloy. Check the screen with red pen. Number of shares. First, this lady bought 50,000 shares from the company at par value, and par value is £1. So 50,000 multiplied by £1 is 50,000. Okay. Then after 1 year, this lady bought 10,000 shares for £18,600. So at one side and in one column we'll add the shares. In one column we'll add the shares. In the other column we'll add the cost. So very simple. Tell me, what is the cost of this total 60,000 shares? The cost of this total 60,000 shares is 68,600. The cost of this 60,000 shares is 68,600. Okay. And now this lady will dispose of all these shares at the rate of takeover. Why? Because it is written she accepted the cash alternative. The cash alternative means she took cash and given the shares. She took cash and given the shares. So it is disposal. It is disposal from her point of view. Okay. Just giving you 30 seconds to analyze. Now wait, let me go to the requirement. Okay. First of all, I'm doing requirement number 2. First of all, I'm doing requirement number 2. What is the chargeable gain? What is the chargeable gain, if any, arising and alloy on the date of takeover of Alphabetic Limited? Yes, there will be a chargeable gain. See this working. Alloy owned 60,000 shares, and you know what is the cash alternative? For one share she will get £6. For one share she will get £6. So 60,000 shares multiply by £6. So the DP will be, look at the screen, the DP will be 360,000. The DP will be 360,000, and I just told you that the cost of alloy is 68,600. So automatically the gain will be 291,400. Automatically the gain will be 291,400. Okay, so for alloy at the date of takeover, this disposal of 60,000 shares will generate a gain of 291,400. This disposal of 60,000 shares will generate a gain of 291,400, right? So this is the answer of requirement number 2. I'm going to tell you requirement number 1 as well. So the answer is 291,400, 291,400, 291,400, 291,400. Now I just told you in the theory reading, I told you alloy met all the conditions of entrepreneur relief. Why? Holding period was almost 10 years in this question. We need 24 months. Okay, she was doing job, she had holding percentage of 5%, and this is a trading company as well. So all conditions are met. So in question number 1, which of the following individuals met the qualifying condition for entrepreneur relief? So for alloy, the answer is yes, alloy met the conditions for entrepreneur relief. Alloy met the conditions for entrepreneur relief. Okay, be active. You have to clear the paper. See, just think that we are working for a cause. Okay, now the second guy or second lady is born. Born has been the sales director. Oh, great. Born is also doing job. The first condition is met. Alpha since 1st February 2018. No. See the disposal date. The disposal date is, I think is the disposal date was 15th October 2019. The disposal date, you can see the disposal date is 15th October 2019, and he joined this company on 1st Feb 2018. So that means this is less than 24 months, almost 18 months, almost 18 or 19 months, less than 24 months. So main 24 months condition has been breached. Having not previously been employee of the company, she accepted XYZ PLC share alternative. See what she did. She opt for share alternative, one for one. So she will get the same shares, same number of shares she already had, but with a different name, of one ordinary share for each of her 25,000 pound one ordinary shares in Alphabetic Limited. Listen to me. That means she gave away her 25,000 shares of Alphabetic Limited, and she got XYZ ordinary shares. Okay, so there is no extra working, no gain, no need to compute gain right now. Okay, now Bond has purchased her shareholding on 1st of Feb 2018 for 92,200. So this is the cost. This is the simple cost, ready-made cost of 25,000 ordinary shares. Now on 4th March 2020, Bond gave 10,000 of her pound one ordinary shares in XYZ PLC to her brother for 50,000. XYZ PLC to her brother for 50,000. Now, wait. Sister and brother are connected person. Sister and brother are connected person. Hope you remember sister and brother are connected person. Okay, so for connected person, whenever you need to compute gain, for connected person, whenever you need to compute gain, you must you must you must use market value. You must use market value. Okay, now, and I told you in my lecture how to compute market value for quoted shares. How to compute market value for quoted share? It's basically the mid market price. It's basically the mid quoted price. Okay, so on that date, the shares were quoted on the stock exchange daily official list at 7.10 and 7.18. Come on, boys and girls, come on, you do it yourself. 7.10 is the lowest quoted price, 7.18 is the highest. Just mid. I mean, we want mid value. The mid value is 7.14. The mid value is 7.14. Okay, thank God. Examiner has written itself what they have written. Gift relief is not available. Gift relief is not available in respect of this disposal. There is no gift relief available. Forget about the gift relief. Okay. Now, first of all, let me tell you in clear cut words, bond is not entitled. Bond is not entitled for entrepreneur relief. Why? Because the holding period and the job period is less than 24 months. Less than 24 months. If you count from 1st February 2018, from 1st February 2018 to 1st October 2019, this is less than 24 months. Just because of this less than 24 months, he is not entitled. He is not entitled. He is not entitled for entrepreneur relief. So let me take in the requirement. Wait, bond does not meet the condition of entrepreneur relief. Bond does not meet the condition for entrepreneur relief. Now, one thing, sir, can you compute the gain? Can you compute the gain of this transaction between sister and brother? Yes, very easy, we can do it. Let's do it. And for that, in this transaction, dp will be market price, dp will be market value. Okay, and we have calculated the market value as 7.14. We have calculated the market value as 7.14. Okay, let me do it because this is the requirement. See, look at here. I've written here, for transactions between connected persons, for transaction between connected person, market value is used as a DP. For transaction between connected person, market value is used as a DP. We just read that this sister transferred 10,000 shares to brother, 10,000 shares to brother. So 10,000 shares multiplied by what is the mid quoted price? What is the mid quoted price? What? 7.14 per share. So if you multiply 10,000 with 7.14 per share, you will get 71400. So your DP is 71400, right? Okay, less you have to deduct the cost. But wait, the cost was given for direct 25,000 shares. The cost was given for 25,000 shares. So what you do, you will apportion the cost. 92,200 divided by 25,000. 92,200 is the cost of 25,000 shares. You divide it by 25,000 and then you multiply it with 10,000 because only 10,000 shares are gifted. So this comes at 36880. If you take the difference, the gain comes out to be 34520. 34520 is the gain. 34520 is the gain. 34520 is the gain of this transaction. Okay, so the answer of question number 3, the answer for this question number 3 is 34520. The answer for question number 3 is 34520, right? Look at the screen, look at the screen, please. Check it out, check it out, check it out, please. Now now the third shareholder, Cherry. The third shareholder, Cherry. Let's see. Cherry has been an employee of Alphabet Limited since 1st May 2010. Oh, great news. 1st May 2010 means almost 10 years. Looks like she might meet the conditions. But wait, she accepted XYZ PLC share alternative of one ordinary share for each of her three. Oh, she had only 3,000 shares. My dear, look at me. The total number of shares of Alphabet Limited was 100,000. The total number of shares of Alphabet Limited was 100,000, but unfortunately Cherry had only 3,000 shares. So 3,000 is just 3%. 3,000 is just 3% of 100,000. So Cherry had only 3% ordinary shares, which is less than 5%, which is less than 5%. So simply you can deny. You simply say bye bye. No need. You can't claim entrepreneur relief here. You can't claim entrepreneur relief here. You can't claim entrepreneur relief here. Okay, right? So let me first take requirement number one. Cherry cannot claim entrepreneur relief. Only alloy is eligible for entrepreneur relief. Only alloy is eligible for entrepreneur relief. Okay, see, so question number 1, 2 and 3, all three are done. 1, 2 and 3 questions are done. Now wait, now what Cherry has done, Cherry gave away old 3,000 shares. Cherry gave away old Alphabet Limited 3,000 shares, and he got new 3,000 shares of XYZ. He got new 3,000 shares of XYZ. Okay. Now wait, what is the cost? What is the cost? 4,800 is the cost. 4,800 is the cost. Okay. Now just check the turn. On 13 November 2019, Cherry sold 1,000 of her ordinary shares in XYZ for 6,600. Okay. Out of these 3,000, he sold 1,000 shares. Out of these 3,000, he sold 1,000 shares. Now open your eyes. He had total 3,000 shares. He sold 1,000. Now how much is left? Only 2,000 shares are left. Only 2,000 shares are left. Okay. Now Cherry died on 5th of April 2020. Cherry died on 5th of April 2020, and her remaining 2,000 pound one ordinary shares in XYZ PLC were inherited by her daughter, were given to daughter. I hope you remember today's class, just today's class. At the time of death, there is no CGT. At the time of death, whatever chargeable asset you transfer to your daughter, to your son, there is no CGT. There is no CGT. On that date, these shares were valued at 15,600. Now let me tell you the law in clear words. Clear words. You open your ears and open your eyes. At the time of death, there is no CGT, so forget about CGT, and the market value the market value of these 2,000 shares at the date of Cherry death is 15,600, and exactly this 15,600 is the base cost of shares for daughter. That's it. No CGT implication at the time of death. No CGT. No CGT. No CGT computation at the time of death. Okay, let's read the requirement number 5. See, what is the allowable cost? See, the 5. What is the allowable cost that will be used by Cherry's daughter in the capital gains computation on a subsequent disposal of her in future? Subsequent disposal means future. That means if this daughter sells these shares in future, what will be the cost? What will be the cost in the computation of gain? The cost will be simple 15,600. See, I have written this statement as well. I have written the statement as well. For transfers, you can read with the, I have written with the red pen. For transfers at the time of death, for transfer at the time of death, market value of asset at the time of death will be treated as base cost for daughter. Will be treated as base cost for daughter. Yes or no? Yes or no? Now, there is only one requirement left, that is question number 4. What is the requirement? Read. By which date must bond pay the capital gain tax due result on the disposal of shares? Yes. Wait. Bond sold at which date? Wait. In 1920, if bonds sold in 1920, then definitely the due date is same as last question. Bond gifted the shares on 4th March 2020. Yes, 1920 fiscal year. Bond gifted the shares. Bond gifted the shares in 1920 fiscal year. So bond for 1920 fiscal year. What is the date of balancing payment? The balancing payment date is 31st January following the end of fiscal year. 31st January following the end of the fiscal year. So 1920 fiscal year ends on 1920 fiscal year ends on 5th April 2020, and after 5th April 2020, what is the 31st January? This is 31st January 2021. 31st January 2021. 31st January 2021. Okay. Okay. Now, my dear students, there is one area, that is CGT on CGT for companies. CGT for companies. Let me give you a quick recap, because this area will also touch, this area will also touch your corporation tax. Okay. For companies, there is very simple working. First you write disposal proceed. For companies there is very simple working. First you write disposal proceed less cost. You get unindexed gain. You get unindexed gain. What do you mean by unindexed gain? Look at me. Unindexed gain means gain before indexation allowance. Gain before indexation allowance. Now student will say, what is indexation allowance? Indexation allowance removes the inflationary element of the gain, because there is some inflation element is also added in the gain. The asset sells, we sell at asset at higher rate. We bought it for 10,000 and let us say we sold it for 15. So this increase in value is because of inflation as well. This increase in value is because of inflation as well. So the tax department has allowed us to remove the inflationary element of gain, and this inflationary element will be removed through indexation allowance. Now the question is, sir, how to calculate? Sir, how to calculate indexation allowance? The formula for indexation allowance is very simple. Cost multiplied by index factor. The formula for indexation allowance is very simple. Cost multiplied by index factor. Sir, will we be given ready-made? Will we be given ready-made index factor? Yes. From this fiscal year, the good news is your examiner will give you ready-made index factor, so don't worry about it. Yes, in past years you needed to calculate this index factor, but now no more computation of index factor. Ready-made index factor will be given to you. Ready-made index factors will be given to you. Okay, so how you will calculate? Indexation allowance is equal to cost multiplied by index factor. You will get indexation allowance, you deduct it, and you will get chargeable gain. Now the question, sir, is there any annual exemption available for companies? No, big no. Annual exemption is only for individual capital gains. Annual exemption only for individual capital gains. For companies there is no annual exemption, but instead they have allowed indexation allowance. So think like that. For individuals they have given annual exemption. For companies they have given indexation allowance. Okay, but one more thing which you must remember. Indexation allowance, IA means indexation allowance. Read my slides. indexation allowance is only available if asset is bought before 31st December 2017. If you have bought, for example, if you have bought asset after 31st December to 2017, then you are not eligible for indexation allowance. So don't forget this thing, mark these dates, that indexation allowance is available for companies, yes, but why? When companies bought the asset, when company bought the asset before 31st December 2017. If a company has bought an asset after 31st December 2017, then there is no concept of indexation allowance. Okay. And one more thing, indexation allowance is only available till 31st December 2017. After 31st December 17, this is finished, this is abundant, no more indexation allowance. The student are asking, sir, can you give one example? Yes, why not? See the timeline, see the timeline. Okay, see the timeline. Let us say a company bought an asset on 1st January 2011. A company bought an asset on 1st of January 2011, and he sold that asset on 31st December 2020. Look at here, company bought an asset on 1st January 2011, and he sold that asset on 31st December 2020. Now in the question there are two index factors given. One index factor is given from 1st January 2011 to 31st December 2017, that is if is equal to 0.256. The second index factor is given from 1st January 11 to 31st December 2020, that is 0.321. Now you tell me which index factor is relevant for us. Which index factor is relevant for us? Only this one. As don't forget this date, we are only eligible for indexation allowance till 31st December 2017. No more indexation allowance available after 31st December 17. So if look at here, if there is any index factors given after 31st December 2017, they are all rubbish, they are all irrelevant, ignore them. So only 0.256 is relevant. Okay, let me explain you with one MCQ. Let me explain you with one MCQ, and I think this MCQ is linked to this question. Okay, come on. Forest Limited Forest Limited bought a warehouse for 250,000 on 31st December 2009. Think over it. 2009. That means they bought it before December 17. That means they bought it before 2017. Yes, they are eligible for indexation allowance. And incurring to 20,000 legal fees. Yes, in connection with the acquisition. Now think, this legal fees is also incurred on the same date, and this is allowed. I told you right on the first initial slides of capital gain that legal cost to buy or sell your chargeable asset is allowed. And as this is the legal cost of acquisition, so this cost is also incurred on the same date, that is December 09. So we had two costs. We had two costs on 31st December 09. One is 250,000 original purchase cost. One is 250,000 original purchase cost, and the second is legal cost to buy. Legal cost to buy that this asset. These two are allowed, and indexation allowance will also be computed in both of them. The warehouse was sold for 800,000. This is the DP in May 2009. Okay, so now this is a very simple question. The asset is bought before 31st December 17, and the asset is sold after 31st December 17. But don't forget, boys and girls, don't forget that you are only eligible for indexation allowance till 31st December 2017. Okay, after that, no indexation allowance. Come on, come on, come on, come on. Look at the sketch. So which indexation which indexation allowance is relevant? Tell me which indexation allowance index factor is relevant. This from December 9 to 31st December 017.276 is relevant, and this is irrelevant. This is irrelevant. This 0.312 is irrelevant. No need to use it. No need to use it. Okay. So how do we calculate it? Come on, look at here. You will first write dp. You will first write dp, then in allowable cost, both costs are allowed. Original cost to purchase, and legal cost to buy and sell. Legal cost to buy and sell is also allowed. So you will deduct these two costs. So 800,000 less 20,000 less 250,000, your unindexed gain will be 530. Your unindexed gain will be 530. And now from this unindexed gain, you will deduct indexation allowance. You will deduct indexation allowance. And what is the formula of indexation allowance? What is the formula of indexation allowance? I told you on the earlier slides. Cost multiplied by index factor. Cost multiplied by index factor. As dear, these two costs are incurred. Both costs are incurred on the same date. Both costs are incurred on the same date, that is December 2009. So we'll add these two costs and we'll multiply this index factor, which is till 31st December 17. When you multiply these two, you will get 74520. Now 5,30,000 less 74520. This is your final chargeable gain. This is your final chargeable gain. This is your final chargeable gain. So your answer is 455,480. 455,480. You can check. Okay. Now only one MCQ is left. Only one MCQ is left. But take out your pen and write one line. Take out your pen and write one line. And I hope you studied this line before. Indexation allowance cannot create or increase loss. Write this line on your page, on a page. Indexation allowance cannot create or increase loss. I repeat, indexation allowance cannot create or increase loss. Okay. Now look at here. Harop Limited sold two assets during the accounting period. Harop Limited. See, limited means this is a company's question. This is not individual question. You have to use the rules. You have to use the rules for companies now. Okay. The first asset, 2 acres land which it had acquired for 20,000 and sold for 45,000. So the cost is 20. The cost is 20 and the DP is 45. Please be active. This is the last question. Just I need your 2 to 3 minutes, but please give me active minutes. Cost is 20, DP is 45,000, and this is your index factor. This is your index factor. Now wait. Let me compute the gain. How we do it? See, look at here. DP is 45,000, cost is 20,000. DP is 45 and cost is 20. The first step, unindexed gain. This is unindexed gain. This is unindexed gain. Unindexed gain is 25,000. From this unindexed gain, you deduct indexation allowance. You deduct indexation allowance. And I hope I just taught you the formula of indexation allowance is cost multiplied by index factor. Cost multiplied by index factor. Boys and girls, can you please calculate 20,000 into 1.48? Can you please calculate 20,000 into 1.48? This will come around 28,000 something. 28,000 something. 20,000 into 1.48 is 28,000 something. But listen, if you deduct 28,000 from here, if you deduct 28,000 from here, you will get a loss, you will get a negative loss. And what I taught you, what I just taught you, that indexation allowance cannot create or increase loss. It cannot create loss. So in the event, listen, in the event if you getting a negative number because of indexation allowance, you just write zero. Then you just write zero and you just restrict your indexation allowance to the amount of your unindexed gain. You can only make it zero, you can't make it a negative number or loss. You can't get a negative number or a loss. Be very careful. Okay, so in the first transaction that is land, the answer is zero. In the first transaction that is land, the answer is 0 0 0 0. Okay, now for the second is 30 seconds transaction. Second transaction, a warehouse which it had acquired for 80,000, cost is 80 and DP is 75. Cost is 80 and DP is 75. That means in the first step you will get loss. In the first step you will get a loss number. You will get a loss number. So whenever you get a loss number, no indexation allowance is available. Whenever you get a loss number, you are not allowed for any indexation allowance. Listen, so DP is 75,000, cost is 80,000. In the first step you get a capital loss. That's it. And I just told you the statement, indexation allowance cannot create or increase loss. So no more indexation allowance in this. So look at the whole picture, the first one answer is 0 and the second one answer is negative 5,000. Now read the requirement. Now read what is the company's allowable loss for the period, assuming it sold no other assets. See, this is C answer. 5,000 is the capital loss. 5,000 is the capital loss. 5,000 is the capital loss. Okay, okay. Now listen, dear student, I hope I we just sent you the WhatsApp group link. It's better you join it. Okay, because we have only 15 hours. We have only 15 hours and already 3 hours been done. Today's lecture has been done. We'll try to cover maximum things, but still the time constraint is there. So join the WhatsApp group. For tomorrow our agenda is IHT and VAT. IHT and value added tax. It's better you revise it before so that you will be more active. Okay, so inshallah see you tomorrow, same time 4 p.m. and our topic will be IHT and value added tax. Okay, so that's the end of our lecture. हाँ एंड कर दें एंड कर दें